XRP takes cover as Ripple's CTO responds to this controversy around. Ripple's CTO Schwartz mentioned that the claims around the centralization of XRP were random assertions with no evidence to back them up. However, is there more to the situation than what meets the eye? The Ripple CTO addressed the talks about the preferential treatment Ripple had toward XRP holders. Weighted sentiment remained negative while social dominance jumped. The heat Ripple XRP has been facing has not just been limited to its issue with the U.S. Securities and Exchange Commission, SEC. Although unpopular like the former, some market players have repeatedly accused XRP of being a centralized entity. Ripple keeps explaining, no evidence. The discussion arose again on 24th of September, as a certain Wolf of Golden Street asked Ripple's CTO David Schwartz about the centralized XRP claims. To buttress his point, the pseudonymous X, formerly Twitter, user noted that Bitcoin BTC, maximalist Max Kaiser, had been at the forefront of the accusation. Schwartz, in his response, mentioned that the claims were random assertions with no evidence to back them up. He said, "I haven't been able to find a coherent claim to answer. Any particular tweet that makes an actual claim? They all just seem like random assertions mixed with insults." However, Wolf of Golden Street was not one to give up. He went ahead and asked Schwartz to clarify the claims that Ripple was only committed to empowering the top 1% XRP holders instead of the entire cohort. Schwartz responded, saying that the 1% claim had no basis, and ownership of XRP could be transparent and could be tracked on the XRP ledger, XRPL. While the CTO admitted that XRP had a centralized design, he mentioned other reasons while referencing Bitcoin, that the token itself is not centralized. Eyes are back on XRP. A look at on-chain data from the XRPL showed that this lack of clarity may have affected the XRP sentiment. At press time, the weighted sentiment was minus 0.061. Weighted sentiment shows the unique social volume attributed to a cryptocurrency. When the metric is positive, it means that there are more positive comments than negative ones in relation to the asset. Therefore, XRP's weighted sentiment being negative suggested that XRP was dealing with more negative comments than positive ones. As per the social dominance, XRP seemed to be getting back the attention it had lost. Previously, XRP's social dominance was down to 1.18%. However, the metric had risen to 1.80%. The rise in social dominance suggested that there was more discussion relating to the asset than there was before. Compared to other cryptocurrencies in the top 100, XRP looks to have grabbed a good share of the assets being talked about often. However, the circulation in the last 24 hours had fallen to 153.48 million. This meant that fewer XRP tokens had been used within the period. On the positive side, the token may not experience any notable selling pressure. Coinbase faces SEC scrutiny amid Celsius network bankruptcy controversy. In a recent development, the Securities and Exchange Commission, SEC, has expressed concerns regarding Coinbase involvement in the restructuring plan of Celsius network. This crypto lending company filed for bankruptcy over a year ago. The federal agency responsible for regulating U.S. securities markets, the SEC, has filed limited objections and reservations of rights in response to Celsius, citing inconsistencies and potential violations of federal securities laws by the U.S.-based exchange. Coinbase participation in Celsius bankruptcy plan. The SEC's objections are rooted in a litigation filed earlier this year against Coinbase, accusing the platform of operating an unregistered securities exchange. Conversely, the regulatory agency alleges that Celsius Network and its former CEO Alexander Mashinsky engaged in unregistered and fraudulent sales of crypto asset securities, including their own CEL token. While the SEC's case against Celsius Network has been stayed pending Mr. Mashinsky's criminal case, the objections raised in the bankruptcy proceedings shed light on the ongoing legal battle. According to finance expert Walter Bloomberg, Celsius Network's proposed restructuring plan involves the distribution of digital assets to customers through Coinbase. However, the SEC's concerns focus on the broader scope of Coinbase's involvement, which goes beyond acting solely as a distribution agent. The agreements in the plan between Celsius and the US-based exchange encompass brokerage and master trading services, which overlap with the activities that prompted the SEC's litigation against Coinbase. One of the main issues highlighted by the SEC is the absence of a clear agreement between Celsius Network and Coinbase and the discrepancy between the stated intentions of the parties involved. Although Celsius Network asserts that Coinbase will not provide brokerage services, the SEC emphasizes the importance of transparent and consistent terms in approving the deal. However, Crypto Miami, a DeFi investor and crypto enthusiast who goes by the pseudonym, views the SEC's objection regarding Coinbase's role in the Celsius case as limited in scope. According to Crypto Miami, the objection primarily pertains to adding a brokerage and master services agreement, while Coinbase was initially intended to be a distribution agent. In the Celsius disclosure statement, Coinbase is mentioned explicitly as the distribution agent for international creditors, with PayPal serving as the agent for U.S. creditors. Crypto Miami believes that this objection made by the SEC does not signal broader implications beyond the specifics of the Celsius case, as the bankruptcy court prepares to review Celsius Network's restructuring plan. The objections raised by the SEC underscore ongoing concerns surrounding regulatory compliance in the intersection of cryptocurrencies and securities laws. Nevertheless, the SEC reserves the right to challenge crypto asset transactions and keeps open the possibility of further objections to the plan's confirmation or related motions. SEC cracking down on crypto. Why you need to protect your digital assets now. Poi Wichman, CEO and founder of Aura Partners, an international trustee and wealth solutions firm, explains the recent SEC crypto lawsuits and the importance of protecting crypto assets in an offshore trust. Following periods of price volatility and the collapse of several crypto companies, the U.S. Securities and Exchange Commission has filed lawsuits against crypto exchanges Binance and Coinbase, as well as fraud charges against one of the largest crypto exchanges, the failed FTX. The SEC has also taken action against a number of crypto lending platforms and decentralized finance DeFi projects. In these lawsuits, the SEC often alleges that the defendant exchanges violated securities laws by trading unregistered securities or they have committed straight-up fraud. While it is still debatable whether crypto is or is not a security, a couple of judges have already found it to be, and SEC Chair Gary Gensler has made clear he believes the majority of cryptocurrencies are securities, based on the Howey test set out in the 1946 Supreme Court decision in SEC v. W.J. Howey Company, 328 U.S. 293, 1946. The SEC's crackdown on crypto is likely to continue in the coming months and years as the agency has stated that it is committed to regulating the crypto industry and protecting investors. While this might be a noble motive, it will likely have a significant impact on the crypto market, as it will inevitably make it more difficult for investors to trade crypto assets. SEC lawsuits plus threats impacting crypto assets. Beyond the inevitable headaches or prudent regulation, depending on your perspective, from the SEC, crypto assets are vulnerable to the now common and routine threats posed by hackers and fraudsters. According to the FBI, more than $10 billion in losses from online scams were reported to the Bureau in the year 2022. That was the highest annual loss in 5 years. The FBI further reported that there was more than a $3 billion jump in reports of online fraud from 2021 to 2022, with a near tripling in reports of cryptocurrency investment fraud. If regulation and hackers aren't enough to keep you up at night, there are additional serious threats unique to crypto assets. For instance, what other investments, other than small amounts of cash, can be lost when a cold wallet is physically damaged or misplaced? What other kinds of assets can be permanently lost when passwords or seed phrases are forgotten, or when the only person who knows these passwords and seed phrases dies? According to estimates from Glassnode data, about 10% of the current Bitcoin supply, or 1,857,721 Bitcoins, might never be found. Other reports estimate it might be as high as 25%, that is billions worth of value which will remain inaccessible forever, essentially reducing the circulating supply of cryptocurrency. So what do these potential threats and lawsuits mean to you and your crypto assets? How to protect your digital assets. Whether you need to protect your digital assets now depends on your individual circumstances. If you are a smaller investor or if you only hold a small amount of crypto assets, you may not need to take any immediate action. On the other hand, if you are a large investor or you hold a significant amount of crypto assets, you may want to consider taking steps to protect your assets, and these steps may not involve either a crypto exchange or a cold wallet. Let's start with the first steps you can take to protect your digital assets. Protect your accounts from unauthorized access by using strong passwords and two-factor authentication. Be careful about what information you share online. Do not give out your private keys or seed phrases to anyone. Beyond the obvious, perhaps consider arranging to have your assets held in an offshore trust managed by a professional third-party fiduciary, and at the very least consider using encrypted cloud storage. With these methods, you can virtually eliminate the risk of physical loss or media failure while maintaining convenient access to your crypto assets using your computer, phone, or tablet, anywhere with an internet connection. Trustees have secure access to your assets and are skilled in properly managing and protecting all assets. Cloud storage providers typically have multiple data centers located in different geographical regions. This means that your files are less likely to be lost or damaged in the event of a natural disaster or other event that affects a single data center. Using these methods, you can be assured that you are utilizing the best available security controls, including encryption, access control, and audit trails. With a professional fiduciary, you can feel secure that passwords and seed phrases won't ever be lost, even if you die or become disabled. It is of course important to choose a reputable fiduciary or cloud storage provider that has a good track record of security. Take action now. No matter how much you invest or how seriously you take any of these threats discussed, here is one last bit of practical advice. Be aware of the risks involved in investing in crypto. Cryptocurrencies are a volatile asset class and there is always the risk of losing money. Take proactive steps now to protect your digital assets in an offshore trust to keep your investments safe from future threats or even potential lawsuits.